Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm going to take a look at Medtronic. These guys engineer the extraordinary. Look at this walking blue man. They engineered the heck out of that guy. Basically, they make medical devices, think pacemakers, diabetes pumps, all of that good stuff. And they are down quite a bit in the recent couple of years. 1 year out, down 11%. 3 years out, down 31% off of an all-time high of $133. Even 5 years out, you're not really making any money even after the dividend. I mean, this is a dividend-paying machine. These guys have paid dividends for 46 years in a row, and not only paid but raised dividends. So they are on the S&P 500 Dividend Aristocrats list. So I do own a few shares here in my Dividend Aristocrats tracking portfolio. Haven't bought them in a while, but they are getting interesting again. So I thought I would revisit the stock and see where I would like to set a price target for me to actually buy some shares. And the reason these guys are down is twofold. One, you're basically seeing a re-evaluation of a lot of these dividend payers who really benefited from very low interest rates leading to very low risk-free bond rates. If you're looking at fixed income and your choice is a 1% bond versus a 3% dividend payer that has paid and raised dividends for 50 years, a lot of people moved into that dividend side, even if those stocks were overvalued. Even Medtronic, ticker MDT, these guys, if you look back on their valuation, their free cash flow valuations were sort of in that like low 3% range. And that's pretty tight for something that basically hasn't grown much since 2016. You were talking about low, high 1%, low 2% dividend yield. And then as you look at their financials and you kind of look at their growth pattern, they've gone from 28 million in revenue to 31 in 2023, barely any movement across, 7 years. Free cash flow from 4 to 5 billion in that 16-17 period to 4.5 billion, maybe 6 billion in 24, 4.5 billion in 23. So why are they getting such a rich multiple? It's because the alternatives weren't really there. So a lot of these dividend payers got repriced to something unsustainable, and that's why they're dropping so much. And the question is, are they getting interesting again? On top of that, there's a double whammy of these guys do business in the medical space. They have a diabetes business, they have a cardiovascular business, a neuroscience business, a medical surgery business. The obvious worry with a lot of these medical stocks is there's this new bevy of drugs that help with weight loss. If you lose weight, you might not have diabetes as often as you did if you were overweight. You might not have as much of a need for diabetes treatment and products. You might have less heart attacks, less heart issues. And if these drugs become really prevalent beyond the weight loss benefits that they give people now, beyond the diabetes benefits that they might give people now, and other companies launch their own drugs and this becomes the new norm and everybody's healthy, that could really hurt a business like Medtronic. I don't know if that's realistic. These drugs will have side effects. They're probably not as amazing as everybody makes them out to be. So there's always going to be need for business like this. That's why they've been around for so many years. That's why they've raised their dividend for so many years. But that is a risk and a concern for investors in this stock. On top of that, these guys just maybe a year and a half ago announced a spinoff of their patient monitoring respiratory interventions business, which is kind of their slower growing but slightly higher margin business, with the idea that they're going to focus on their higher growth, highest growth, synergistic, and established market leaders businesses that are growing at 3 to 4% or 10% plus in that high growth space, which they think is going to allow them to more likely deliver, mid or upper single digit organic revenue growth before acquisitions. On top of that, when they spin off that business, they're going to acquire some money that they can use to pay down debt and or buy back shares and or issue a dividend and or acquire companies that are going to help them grow faster again. Obviously, that business is a $2.2 billion business that they're spinning off, so it's going to be a initial cut to their revenue, but it is a spin-off. They're still going to own a third of the business that is being spun off. And the latest I read about that is maybe there's an offer of about $7 billion that would come into their coffers that they could use to make some M&A plays or what have you. And these guys are always inventing, iterating, etc., making acquisitions, etc. So it's an interesting business model. It's just one that hasn't really grown despite the acquisition. So why people Why do people invest in this? Well, it's a free cash flow machine. It is consistent, whether it's the 2020 pandemic or the 2008, 2009 recession. These guys continued to make money. Go back to 2008, 2009. 3 million in free cash flow. Their EPS is positive. Their net income is positive. Barely moves, right? Even their revenue continues growing through the Great Recession. If you go to 2020, a bit of a dip here, but not a lot. Then an improvement the year after because of the respiratory stuff they do. Free cash flow was still positive. EPS was still positive. They grew their dividend. I mean, that is consistency. That's why people like it. That free cash flow is used towards R&D. Obviously, that's not part of the free cash flow, but also M&A, some tuck-in acquisitions. Nothing huge so far. Most of it isn't really accretive at the moment to earnings, but will be eventually, hopefully. The reality is that they're using majority of that money to pay dividends and buy back shares. They're prioritizing dividends. They're kind of a dividend payer. That's why you would buy the stock. It's just, are you buying it at a good enough valuation to make that worthwhile? That is the question for me. And that's what I'm going to look at. I'm not really considering the spinoff at the moment, but I might talk about what that means for their financials. If you look at their financials in general, let me turn off this thing. Their balance sheet looks pretty decent. They have about $8 billion in cash versus $24 billion in debt. So there is some debt. The good thing is that maybe only 500 million of it matures in 23, 24, another 2.7 billion in 26, then between 26 inclusive of that 2.6 billion until 2030 there's maybe a total of 6 billion, so another 3 billion or so from 27 onwards until 2030. So they don't have a huge debt liability that's ahead of them that is going to put a lot of pressure on them. On top of that, they have a ton of free cash flow that they're able to generate from their business that is going to allow them to pay down that debt. And you can kind of see that they've been doing an okay job with that. Free cash flow is a good thing. If you look at what they're paying out in dividends, it's about 3.6 billion against 4 to 6 billion in free cash flow. So there's money left over after the fact to buy back shares or make acquisitions or whatever without taking on significant debt, which is always a good thing from a business like this. So let us look at the financials before we go into that. Disclaimer, again, this video is purely for informational purposes, whether it's educational or entertainment purposes only. It is not investment advice. Do your own due diligence, talk to a qualified financial advisor, all of that stuff. I will put this valuation spreadsheet in the description down below, so take a look and play around with it if you'd like. I am using the baseline estimates from Ticker and then making my own adjustments. So I don't think this business is going to grow a lot at all from this point forward. For now, I'm not assuming anything around the spin-off because obviously if they spin off this $2.2 billion business, their revenue will take a slight dip in the interim and then start growing at maybe a faster clip from there. Might take a slight hit to operating margins, to free cash flow margins, because that business is slightly higher margin than the remaining business. But again, you will still own that business after the spinoff as a shareholder. Don't know what will happen with the dividend. Hopefully, I mean, I would assume that they're going to keep it whole between the two companies, but maybe MDT will pay a slightly lower dividend, and then the spinoff will pay a dividend that makes up for the rest. So it's at least continuing to grow. So they keep that Dividend Aristocrat status. Assumption here is that growth is going to be in that 2 to 2.5% range for a while. I'm not expecting this to explode. Obviously, some risk with some of these drugs to this assumption. If they do spin off this business and they can make some smart acquisitions and really get back to growth into that mid to high single digit range, could be some upside there, but I'm not really expecting a ton from this business. And you shouldn't either. If you look at, like I said, between 2017 and 23, they grew, what is this? 10%, 5% even. So that's barely anything. So 2.5% is maybe a gift. So keep that in mind as you think about this valuation and whether or not it's realistic or not. As far as buybacks go, they've generally been buying back shares, not a huge amount in the last couple of years as they focused more on dividend payments, etc. Their free cash flow was a bit pressured as their business kind of grew a little bit. They've made some investments, some M&A acquisitions that are negative on margins in the first couple of years. I'm still assuming maybe a quarter of their cash flow, which is about 31 billion in this assumption. I'm assuming a margin of 18.5%. Basically for the 5-year period I'm looking at here. There's potentially some downside to some of these years. You can see that they've been as high as 21%. They've been as low as 14.5% in the last year, but I'm hoping that they can kind of even out in that 18.5% range. Don't think it's overly aggressive, but certainly some upside or downside risk here as well. This is a consistent business that's going to have some up and down years, but in general, it should produce a decent amount of cash flow year over year. So I'm talking about $7 billion in buybacks, a dividend growth rate of about 2%. So they're paying about a 2.76 annual dividend right now, which is about a 3.8% yield at today's price of 71.27. That is not growing quickly. In the last year, it grew at about 1.5%. So I'm assuming actually 1.5% for the next couple of years. So it's a 3.9% dividend yield today, maybe about 4.1% yield on cost 5 years from now in 28 if you invest today at today's prices. So that's about 18.9 billion in dividends against free cash flow of about 31 billion, excess free cash flow of about 12.2 billion. 7 billion of that is going to go to buybacks. In this scenario, they'll have about 5 billion left for acquisitions, what have you, additional dividend growth, additional buybacks, etc. Seems reasonable to me. Today's valuation kind of puts this at a 4.9% free cash flow yield based on the 2023 actual results. If you kind of go back to 24 estimates or even 2022 actuals, it's closer to 6%. So my assumption here is that this stock should really be priced in that 5 to 6% range, maybe some upside into the 4% range if yields drop a bit. But really seems fair for something this consistent that's not really growing that much to kind of get, a market multiple that's in that 5 to 6% range. So I'm putting 50% of this scenario in the 5% cash flow yield bucket, 40% in 6%, and then 10% in the 4% bucket. And maybe that's a bit optimistic on the 4% side, but you can see what happens when the yields drop. So there's potentially some upside there and some downside if yields continue to stay elevated, which is why I'm kind of moving towards the 6% range. But you can kind of see the actual expected returns inclusive of dividends, depending on the free cash flow yield you choose. Based on my scenarios, the weighted expected return inclusive of dividends here is about 10% from today's price, which isn't bad, but it's not quite what I target when I make individual investments, especially ones that have some question marks in regards to their growth potential, to the spinoff, to how the drugs impact their future growth, etc. So, if you're a bit more pessimistic about free cash flow yields in that 6% range, it's a total return of about 7.8%. And really, if you're targeting something in that 11% range prior to dividends, which is kind of what I am, which brings me close to 15% all in, based on these scenarios, that brings me to a fair value of about $59. So about 16% off of where it is today. And you may say, well, that's crazy. This stock hasn't traded that at that level since like 2016. But really, they've had the same revenue since 2016, the same free cash flow since 2016. So why am I paying so much more for it today than I did back then? Really, what I'm buying here is slight growth and a decent, consistent dividend. And I would need a pretty good return profile to drive that. And there's some downside here. Obviously, if the market prices this at a lower free cash flow yield, you're talking about a 5% total return. But the downside is relatively limited, even down to a 10% free cash flow yield. The return is still pretty positive because of what the dividend does for the return based on the price it would be at a 10% free cash flow yield. Because I do believe this is a pretty safe dividend. I do expect that when they spin this off, the dividend might be split between the two companies for, if it's 286 today, 276 today rather, maybe 16 cents will be paid out by the spinoff and 260 will be paid out by Medtronic or something of that ilk. So something to keep in mind if you're an investor. Do you want to hold the spinoff to maintain your dividend whole, or do you want to sell that? Are you worried that the dividend will be cut during the spinoff? I don't think so, because they do have the flexibility to maintain it and even raise it at a bit higher rate. But I think what they should be doing now is, keeping the raise reasonable, 1 to 2% is fine. Focusing on finding growth opportunities, R&D, that's going to buoy their business lines, maybe some M&A acquisitions that are priced at a fair value now that they can use to grow their business and get that multiple expansion that they would deserve if they grow their business, right? They don't really deserve a multiple expansion as they got during the pandemic or post-pandemic because they weren't growing their business. They're basically a static, consistent business, and that's fine. If you're looking for a dividend payer, this seems interesting. From that perspective, at today's price point, you might get, a decent overall return in that 10% range. But for me, I need a bit more because there's some downside. If the free cash flow yield ends up trending towards 7% because the market starts saying, well, interest rates keep rising and this guy isn't really growing at all, the fair value there is $45, right? The 6% fair value is $52. So this is kind of a scenario weighted fair value of $59. And what I do with this fair value personally is I kind of throw it into Fidelity. I set an alert there that says, hey, let me know when Medtronic hits 59.58. And sometimes with these fair values that I set, my phone will say, hey, buzz buzz, here's a text from Fidelity that says this stock has hit this price point, and then I'll do a quick look to make sure nothing changed from my original review of this stock that I do in videos like this one, and then I'll buy a handful of shares at that moment, because it seems like from a $59 price point I could potentially get a 15% return, consistent a dividend payer, some potential growth, and I do need that higher return than a market would offer. I'm kind of expecting 7 to 10% from the market from just an S&P 500 ETF, because I'm taking the additional risk with individual stocks. There's unknowns with something like this because of the drugs that are out there, because of their spin-off. So I'm looking for something a bit more than just 10%. And obviously you can play with these scenarios as much as you will. For example, if I remove the 4% scenario and kind of put it into the 6% range, now the expected return is closer to 9%. The fair value is closer to $57. So you can do that on your own. But let me know what you think about Medtronic. Clearly a pretty good company. Like I said, it is a Dividend Aristocrat, so I do own a little bit, like maybe $600 worth of shares, so not a lot. I'm still probably positive on it because I bought it so many years ago. But at the end of the day, it's a stock that I would be interested in again, but I would still need a lower price point than it is today, because it's just it's not super enticing at $72, even if it's back to 2017 prices. You may look at that and say, wow, it's back to 2017 prices. Must be a great deal. But have they grown since then? No. Have they increased free cash flow since then? No. What's changed about the business that makes it worth that much more, especially now that interest rates are much higher than they were in 2017? If anything, it should be lower than 2017 for me to be interested in it. And that's why my fair value is $59. So that's my take on it. Let me know what you think about Medtronic, if you're interested in it, if you're a buyer at this level, or if you're waiting for it to fall a bit more. For some people, 10% is perfectly fine, but with the risks associated with this, I would want a bit more, which is where the fair value is. If you enjoy these videos, let me know in the comment down below. I'll probably do a bit more of these Dividend Aristocrat videos, because some are getting interesting, just like Medtronic is. It's just a bit away from where I would want to purchase more. If you enjoy these videos, as always, subscribe. Welcome to all of you new subscribers. Thank you for the nice comments that some of you have made. And like the video, and have a good rest of your day. Bye.